So we just finished the month of July, and I'm happy to announce that the Offside Portfolio is up, outperforming the market, still having over half of its value in cash, and proving our thesis around everything that's going on correct. So this is a new series. At the end of each month, I'm going to give you the portfolio update, the correlation metrics, the strategy, the philosophy that we have in our view of the markets for that month and for the coming quarters and future months. So right now we're going to cover the second half of 2026, what our portfolio did over the past 2 months, what drove it, what the risks are, and what the lessons were. So without further ado, let's get into it. So let's start with the scorecard, right? So we have an 8.5% performance with the safety net still on. So 8.5 total return on the portfolio, which is roughly on cash return, 16.5%, an unrealized gain of $8,032. As I said before, we're over 50% in cash. We're only carrying a 5.3% portfolio volatility, which comes out to be a 1.5 Sharpe ratio. So of course, if you understand these metrics and run them for your own portfolio, then you understand this was a pretty good month. Now the ledger, how half a book is still in cash but compounding. So we have an overall positioning or NAV at the start of the month in June at $100,000. We're now at 108,493. Still over 51% in cash, 8.5% as I mentioned. We have realized $719 from our long short equity positions and overnight futures hedging activity. So pretty good overall. We're still, again, at the cash exposure that I want to be, keeping us within that volatility ratio that I like to remain under. Now, the four principles that drove these results. First, cash is a position. Most of the gurus and advisors out there in Twitter and pretty much financial media overall will tell you that being in cash is sort of missing out of the market. And the reason is these guys are incentivized to be always invested. Cash is a position, guys, and sometimes cash is the best thing you can have in your portfolio. For us, it is not only a diversifier, it is not only a good thing to have during DXY index swings, during bond yield swings, but it is also dry powder, so we can take advantage of the future rotations that we're watching, all of which you are already aware of if you follow the Offside newsletter. Now, the second point and principle is that we concentrate on our edge. So our edge is found in expectations investing, top-down analysis, and rigorous financial and valuation analysis. So we don't care about the story, we don't care about valuation at the beginning of our process. We want to know what must be true in the future for today's price to hold. And we'll cover some examples in the coming slides, but it's the reason why we've avoided the semiconductor and memory sell-off while our positions are up over 20% from their lows. So that goes to show our process still works and is continuing to work due to the top-down analysis that we'll cover in a minute. The third pillar is risk before return. We obsess about risk, whether it is the positioning, the volatility, the correlation of the portfolio, and even more specifically, each time we buy a position, we care about risk in the company. Do we understand the business enough? Do we understand where the blind spots are? Do we understand how the macro or industry dynamic could affect the company itself? And look, if we end up skipping a company that goes up 50% the next month, we're okay with that, because otherwise we could buy into a company, get blindsided, and then realize a loss that would have otherwise been avoided. Now, the fourth pillar is asymmetry and quality. We look for 3-to-1, 4-to-1, 5-to-1 underwritten upside. When I say underwritten is once we do the analysis in a company, we want to have that 5-to-1 ideal ratio of we're looking to deliver a multiple on our money. We're looking to deliver that multiple with the least amount of volatility possible. And that all starts with the fundamental analysis. Then we run this through a correlation matrix, quantitative filtering as well for the stock, which gives us the quality of our position and our sizing of the position. Now, we have a current outlook, which can be boiled down into we're cautious on the AI trade and we're tilted toward quality and cash. So right now, the market, as we all know, is concentrated in a narrow group of AI megacaps. And while that is holding the index in a bullish way and all the momentum, we've seen the rotations happen over the past 2 weeks. We saw the momentum factor sell off by 15 to 18%. Most of these semiconductor and memory trades are in a bear market, so 20% or more off the lows. And what's been taking their place? Well, RSP, equal weight S&P, which is basically the breadth in the economy. We've been seeing the quality and value factors overtake. So that's essentially leading our portfolio decision and why it's so important to have that top-down awareness in your analysis. We're cautious, and the reason we're cautious is because we don't know what the spillover effects could be from all these off-balance sheet deals on Nvidia, the circular financing, the bond market collapsing, and the CDS product spiking for a lot of these companies. So we're cautious around picking the AI trade. If we do see a rebound on the momentum and growth factors, there are some names in our screening that could make the cut and make it into the portfolio, right? I'm not an outright bear on AI. I think AI is going to work over the long term, but you have to be very, very specific on how you pick this company. So rather than spend my time and energy trying to find the best AI pick, I just go where the money is going, which is value, quality, balance sheets. So we're positioning around a quality tilt and a 50% cash buffer. Now that cash buffer could decline in the coming months as we see the rotation accelerate. So as we see a lot more of our value, quality, balance sheet, cash flow companies start to outperform, we might as well just keep buying more of them. So that's the caution there. That's why we're keeping all the dry powder as we await for our thesis to keep playing out. Now we go over to the factors, and as you can see in June, which was when the portfolio was incepted, we saw a big turnaround in yellow, which is the momentum factor. It topped and is now down over 15% from the high, so essentially a bear market, translated into all of these semiconductors and memory stocks that are down as well. At the same time, we see in red the value quality factor that is taken up higher from the lows, beginning to form a potential uptrend into a bull market. So essentially, that is where we want to be, where we have the lagging factors being down over 37% over this entire cycle, the entire period, and you have all of the concentration names outperforming by a massive deviation amount. That is where I like to see where I can hunt, and right now that's value and quality. So picking those areas can give you potentially the best reaping of the rewards, the best harvesting of future returns, and all that is well with risk reward, which is tied to that 5-to-1 ratio that I talked about earlier. So where we lean in right now in the market is we hunt in the wreckage. So there are 3 unloved areas that I believe could turn out to be the best performers in our portfolio. Right now, as I mentioned, that's value, the lagging factor in the market, could deliver the most upside on a proper rotation, which is arguably already starting. Then we have our cluster of exposure, which we're going to get into next, is the beaten down software name. So as we know, for every dollar that goes long the semi-memory trade, roughly 30 cents goes short the software area as a hedge. So what happens if we continue to see the unwind and momentum and growth? We are going to see the rotation back into the software names where the shorts need to cover the positions. Now, coming up next, we have the mid-caps thesis. If you read all about it, you know what's going on. If not, I invite you to check it out in the Offside newsletter. We also have the bond positioning, the China tech positioning. All of those theses are connected, believe it or not. If mid-caps go, so do bonds, and so does Chinese tech. And all of which is going to be covered in our deep dives within Offside Premium. Don't forget, we're running a 7-day free trial right now, so feel free to check it out below. Now, every position we have, and obviously over half the pie chart is cash, for the reasons that we outlined below. And for now, we have Adobe. Obviously, that's software that could trickle into the value, the quality, and the growth sleeve, but mostly value and quality. That is right now 8%. Then we have Microsoft, same thing, quality and value, that's 7%. Workday, same thing. So we have quality value, that's 7%. And as you can see, Those companies represent a lot of the portfolio right now. So that is the core sleeve that I have built up for you. That includes Alibaba. So Alibaba at 6%, that is a China value and quality company. So all of those in blue, which I've dragged out of the pie chart, represent our quality and our value sleeve. And as you can see, they're pretty well balanced in one of the core positionings. Four of them are the pillars. And then we have two smaller ones that act as a diversifier in the consumer value and quality space. That's going to be Domino's Pizza and it's going to be PepsiCo. For yellow, we have the growth sleeve. We can't just be focused on value and quality because we are going to have some rounds of days or weeks where the market starts to bid the momentum and the growth trade. Now, while I can't outright pick the AI names in that momentum and growth rotation, I feel pretty confident in picking these, which should go up by default or by association when we have those days where the market prefers growth and momentum. Those names are going to be companies like Uber. We're going to have Lululemon. We're going to have Kava. We're going to have On Holdings and Celsius. All of these have been covered in a deep dive analysis, price targets, execution zones, and the entire thesis within Offside Premium. So again, take advantage of that 7-day free trial and read up on those theses, run it through your favorite AI model, and just get the summary version of it. So at least you're aware of what's going on. Now, correlation. This is a practice that everyone should run. Sadly, not a lot of people know how to do this or how to interpret this. So I put every single name and their weighings, whether I'm long or short, and tried to get the volatility clusters. And right now, obviously, we have a cluster around a software. So Adobe is 44% correlated to the portfolio, Workday is 43%, and Microsoft is 43%. So obviously, the portfolio is mainly driven by that clustering in software. This is a risk. Obviously, it is a red flag that I am trying to tackle and I'm trying to mitigate as much as possible with independent diversifiers. As you can see, the dollar is negative 5% correlated to the portfolio. And because it is the majority of our portfolio, it helps as the major diversifier of our positioning. Now, for active names, we have Pepsi, that is 7% correlated. Kava is 11%. We also have Celsius and other names that are very, very lowly correlated to the portfolio. So what happens here is as we see major swings in software, as we saw last week, Workday was up 10% one day and down 10% the other. Still, the portfolio ended up in the green for the week and for the month. The reason is we've been implementing these independent diversifiers into the portfolio, and we are expecting to continue to do so. That's why we have over 50% in cash, and we have all of our future rotation watch list in play so that we can implement them once the price action is constructive. Once we do that, the independent diversifying effect will benefit our portfolio. And right now, it is not that volatile, but I'm just telling you that the cluster and the risk is centered around software. So we're trying to diversify away from that and protect our blind spots. And again, you should do this for your portfolio. Everyone you follow and advises you on running a portfolio or copying their portfolio should tell you about this measure, because if they don't know where their blind spots are, where the centered risk is, neither do you. And when you have a good day, you don't know why you had a good day. And when you have a bad day, first, you won't see it coming, and second, you don't know why you had it in the first place. So here we go on the concentration and diversification specifically. We've ranked everything as far as what drives our risk and what diversifies it. So obviously, the core companies here, Adobe, Workday, Microsoft, and software, they're over 40%, so pretty concentrated, as I mentioned. That is also our engine. So our engine of performance over the past 2 months has been our ability to pick the software rotation based on those factors I mentioned, away from momentum and growth, back into quality, back into value. So whenever that shifts, we are going to have to execute on our watch list names for the growth sleeve, some of which are Celsius, Kava, On Holding, Alibaba, Lululemon, and Uber. So as you can see, we have a pretty tame list of diversifiers to be pulled on in case we see that rotation go the opposite way. We also have about 20 names in our watch list that are being covered soon this week and this month in the Offside newsletter. So each of those are in the pipeline. Whenever we need them to come into the field, we'll pull them off the benches and you'll see the benefits in the volatility. Now, the average stock swing or annualized volatility in our portfolio is 18%, which is roughly the VIX, right? So over the past 2 months, the VIX has been on average around 17 to 19%. Our asset base is 18%. So we're matching the VIX. By default, we should be on the curve of volatility to return as the S&P 500. Lucky for you, we obsess over risk and we try to manage that correlation relationship the best way we can. As a result, our portfolio volatility is 5.3%. So while our asset volatility is 18.2, matching the VIX, our portfolio volatility is 5.3, meaning we're allowed to take on more risk without sacrificing our returns. And as you can see, our portfolio is up 8.5%, outperforming the S&P 500 while taking a lot less risk than the index itself. That's basically what this is saying. Now, low volatility is what makes our sharp ratio, our target realistic. So we're targeting a 1.5 sharp. I mean, anything above that, you're trying to say that you're the smartest guy in the room. I know I'm not, so I'm only going to target 1.5. Given the 5.3% volatility that we have in the portfolio, 1.5 would get us to around 8% annualized. We've already reached that within the first quarter. So I guess that we could outperform this if we continue to add smart exposure. Smart exposure means we add more lowly correlated names to diversify our software positioning. That would keep our volatility low. I want to target anything below half of the VIX. So roughly, if the VIX is 18, I want to remain below 9%. Right now, we have around 4% room to increase our volatility, which if we keep our sharp around 1.5, could get us to the 20th percentile, low 20s, mid 20s in percentage performance, which is our target for the year. So we have half a year to increase our volatility by roughly 4%, remain at a 1.5 sharp, and end the year at a pretty good note. But so far, the annual target has been met in a quarter, so I would say we're doing pretty good. Now, why this matters? This is what disciplined money management looks like. Don't buy the story that if you go all into something and you get lucky, then you make it out okay, because if the opposite happens, you're wiped out and you're out of the game, right? So first of all, transparency. I want to be transparent with you. I want to show you every position, my weight, my correlation, my volatility in the portfolio, and I'm showing you the numbers. I'm not claiming to be a great portfolio manager or a great analyst. I'm showing you exactly what the work looks like. Risk first. Everyone tells you about the reward. Everyone tells you about the growth fictional story that is happening around AI and what they expect the company will do next. I mean, I've heard Caterpillar's becoming an AI company and they'll use AI for the tractors and make billions and billions based on that. There's no proof of it. There's no story. So instead of focusing on the story, I like to focus on risk. And I've shown you that. We obsess over risk so that we don't blow up. And third, you need to have a repeatable process. So each month, each week, each day, you can sit down and start from point A and finish at point Z. But you can only do that if you have a repeatable, systematic process. That's essentially what we do. That's what we're all about. And that is why our portfolio has been protected and it has outperformed the S&P while keeping you, without all the headaches that come with the stock market. Now, you've seen the results. I want you to come and get the reasoning. I want you to come and study our philosophy, our strategy, the metrics I've just shown you, how to run them for your own portfolio, how to find the best ideas and screen for them from our top-down awareness model, from the expectations investing model. I've shown you how to do it with Domino's Pizza. I've shown you how to do it with Adobe. I've shown you how to do it so you avoid the 50% crash in SanDisk that we had over the past quarter. Now, all of that, I'm giving it to you inside Offside Premium. Inside Offside Premium, you're going to access our live portfolio execution, positioning, updates in real time, entry, exit, decision making, hedging, everything you need to copy and paste my portfolio. The value software, consumer, every deep dive on a company that I run is going to be available to you. You also have one-on-one support access from me inside the community, inside email. So I'm one email away for you. A lot of members have asked questions from career to academics to what's happening in markets, how they could even run their own portfolio. And I always answer in the best capability that I have. So you could access all of that 7 days free and have all of the measures and tools in your box by the time you sign up. 7 days is all you need. If you like it, you stay and you keep outperforming the market. But for now, that's all for me. I'll see you next month in the next monthly coverage of our portfolio. And of course, I'll see you this week on other segments of the channel as we cover PMIs and everything else that's happening in the AI trade, specifically with the Citadel bailout of situational awareness. That's all for me today, guys. Enjoy your weekend. I'll see you in the next one.